Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Home Depot, ticker symbol HD. I think that this could be a very interesting add to a portfolio just because it has very consistent revenue. It seems as though there's always people going to Home Depot. They have a pretty large market share in this space, and overall the stock's done pretty well. I do expect that this stock is going to have to come at a premium because of how defensive and strong it is, and it also boasts a pretty strong annual dividend. So to get into the specifics of the stock is up 5.03% over the past year. It has a market cap of $393.97 billion, a price to earnings ratio of 26.6, and an annual dividend yield of 2.32%. Here we have the trailing 12 months of revenue, and as you can see, it pretty consistently does go up. There are certain years that are better than others, but not by very much. And as you can see from the quarterly revenue, there are certain quarters that do a lot better than others. But overall, the line seems to be trending upward, but it also seems as though this is a mature company and it is difficult for them to find growth. So I think that this would better suit an investor who doesn't necessarily need the growth and doesn't have an extreme time horizon, but wants to better preserve their value and get a decent dividend. So I think that this company would be great if you're looking at owning this company for a retirement portfolio or just steady dividend income or just a store of value. I kind of see Home Depot as more of a stock that's an extremely defensive play, just a long-term investor who wants steady dividend income streams and predictable results that are steadily increasing over time. Now, analysts seem to generally have a buy rating on this stock, with 21 rating it a buy, 13 rating it a hold, and then the rest either rating it a strong buy and 1 rating it a sell. And the analyst price targets range anywhere from $294.32 to $484, with an average analyst price target of $431.49. I also wanted to highlight their dividend growth rate. Their 1-year dividend growth rate is 6.22%. Their 3-year dividend compound annual growth rate is 10.89%. Their 5-year dividend compound annual growth rate is 10.59%. Or their 5-year, dividend compound annual growth rate is 10.59. And their 10-year dividend compound annual growth rate is 16.95. So there are pretty steady increases in the dividends. So if that's the important thing that you're looking at, there is pretty significant growth. The 1 year is obviously pretty skewed compared to the 3-year, 5-year, and 10-year, which are the more important ones because that's obviously going to show more consistency. So some years you're going to have better dividend growth rates than others. And it looks like overall you're going to get around a 10% growth rate on average from just the 5-year and 3-year compound annual growth rate of that dividend. I wanted to review this stock because I think that if it's selling at any sort of discount, this is a no-brainer type of buy, but I don't expect that it will be just because it's such a quality company and it is such a defensive company that it makes sense that it would be regularly selling at a premium just because it's a very mature, very safe sort of company, and that it's going to consistently have people buying from Home Depot even during a recession or during hard economic times because those raw materials are necessary for building different structures or, even doing different kinds of work. So I think Home Depot would be a great add to your portfolio as a company, but I do think that the valuation could be a little bit lofty. And if we want to look at that, let's head over to the discounted cash flow model. Here I have my weighted average cost of capital for Home Depot of 6.69%. This is based off of a cost of debt after tax that I calculated to be 3.198% and a cost of equity of 7.152%. And we can see that the weighted average cost of capital is closer to the cost of equity simply because the weighting of equity in Home Depot is 88.29% and the total debt weighting is 11.71%, which I actually kind of like this mix because the cost of debt after tax is lower than the cost of equity, so you do want more debt in general for this cost mix. But you don't want too much debt, obviously, because that can be unsustainable in a time of extreme stress or a rare circumstance. Obviously, COVID helped out Home Depot pretty immensely because people were improving their homes. But if there's an anomaly type of event where Home Depot does have a bad year or two, you don't want a lot of debt on the balance sheet so that they can recover in a pretty healthy way, right? I also want to add some notes before we get into the actual model. For the cash and cash equivalents, I actually included all current assets because receivables are a really big part of Home Depot, and the inventory is also a really big part of Home Depot. So I thought that it made sense to add this into the total just because I thought that it would be more accurate of a metric if I included their receivables, simply because so many of their customers put things on their receivables and then pay them back later, right? I probably should multiply this by a certain fraction or something like that based on how many of their receivables they're actually getting. But just keep that in mind for the model, that the valuation is going to maybe be a little bit higher based off of a DCF perspective than what it would normally be. But we can see that the average revenue growth is 4.2% since 2021, including the trailing 12-month number. And the revenues are a little bit funky. You can see that from 2021 to 2022, it obviously grew pretty immensely. But from 2022 to 2023, it actually shrunk. And we can see kind of differing patterns in the free cash flow, but it's kind of strange because they average very closely to around 4%. And if we put a 4% growth rate in the free cash flow, we can see that there's 42.08% downside in the company if you only expect the growth rate of the free cash flows to be 4% on average over the next 9 years. And I think that that might be explained by the fact that they're very aggressive with buying back shares, and that obviously affects the cash flow, but that does help the overall number of shares, and that does lead to a higher value in the share price, right? That's just something to kind of think about, that this company is probably currently technically overvalued, but I think it's a very strong company with very consistent results. And if you're an investor that just wants a company that's very defensive, gives a good dividend, but doesn't necessarily grow at as high of a rate as the market, I think that Home Depot could be a very good buy, especially with all the uncertainty that's happening right now. But I also think that it's probably overvalued. I'm not a financial advisor, and obviously this isn't financial advice. But I think that there are better options for defensive stocks, just in my opinion, for my situation, because I have a lot of time to be investing. And I think that Home Depot is very mature as a company, and it's going to be hard for them to grow at a significant rate into the future. And they have to do things like share buybacks in order to increase the value of the shares. But I also think that the company is an extremely high quality one, and there's not really going to be a lot of times where the DCF is showing that this company's at a discount. It's kind of the same situation as Waste Management, simply because the company is so strong fundamentally and the revenues are so secure that you are going to be paying a price for that. And it makes sense in this model because even though the analysts are generally bullish on the company, we can see that on average, to justify the current price, they would have to be at around an 11% growth on average for the next 9 years of their free cash flow based on the calculations that we have here for it to be around fair value. And there's still downside with an 11% growth rate of the free cash flow on average. And we can see that the average free cash flow growth rate, like I said before, is only 4.09%. So you would have to be expecting Home Depot to be able to grow that free cash flow by a significant margin. I think that this definitely could be possible, but I really think what's going on here is what I said. This company is very securely going to be able to grow. So I think that it would make sense to buy this if you're planning to hold for at least 5 years. So then in the next 5 years, when the revenue is on average significantly up, it's going to look a lot better if you had bought in now and held for those 5 years than if you buy in now and then sell in the short term, in my opinion. And again, you're also collecting a pretty good dividend, and the company is going to continue. It is going to continue to grow, but it's not going to grow at the rate of a lot of other defensive stocks. But I also feel like this company has a lot less risk in it, and that's where a lot of value comes in. Because when you have consistently growing revenues, even in a mature company without a lot of risk necessarily, because like I said before, people who are going to Home Depot are going to be buying these items pretty much because they have to, whether it's to build new infrastructure and things like that. I think that you could definitely justify buying into this, just because I do think that there is going to need to be a lot of new infrastructure into the future. And the new tariffs are probably also going to help Home Depot just in general, so maybe the market's pricing that in as well. I think with all the uncertainty, Home Depot has run up a pretty significant amount. I just don't think that I would want to make the bet on Home Depot at this price. I think that a good price to get in at would maybe be around the 7%, so around 289 I think is a good price to get in on Home Depot if it ever dips that low, which I don't think will happen, because it seems like defensive stocks now are being favored by Wall Street just in general, which is why I wanted to kind of get a value and get a gauge on Home Depot. But I think that it's already run a pretty significant amount compared to where it was a couple of weeks ago. And I don't want to add this one to my portfolio, but I'm really interested to hear what you guys think and just overall what you think of Home Depot as a company. Thank you for watching. If you made it this far, I really appreciate it if you hit the subscribe button, hit the like button. Let me know what you think down in the comment section down below, and I'll see you guys in my next stock analysis video. Bye.